Silver at $100 doesn't mean you're late. It means the rules just changed. For decades, this market was trapped under one psychological ceiling. But now it's broken. And silver didn't just cross $100. It traded as high as $115.59, with China printing over $110. That's not a test. That's price discovery. And here's the paradox. The higher it goes, the more people rush in. Because triple digits doesn't scare buyers anymore. It attracts them. If you're waiting for $90 again, you're not being patient. You're risking getting locked out as new support forms above the breakout. But here's the part nobody is saying out loud. The biggest danger isn't volatility. It's liquidity. Because in this market, two people can own silver at the same price, and only one of them can actually sell it fast when it matters. And the difference comes down to what you're holding. Silver clearing $100 is being treated like a finish line, but it's actually a starting gun. The moment that resistance snaps, the market stops behaving like a slow value trade and starts behaving like a momentum machine. You can see it in the numbers. The move from $20 to $30 took 145 days, but the move from $90 to $100 took only 10. That's time compression. That's the market changing speed without warning. And when price moves in days instead of months, the old playbook dies. Weekly analysis becomes too slow. Monthly waiting for confirmation becomes a liability. Now watch how fast this escalates. Once the crowd believes $150 can happen in weeks, they don't wait for a dip. They buy to avoid regret. The question isn't whether silver is expensive. It's whether the window to build a position is already closing. Here's the uncomfortable truth. Silver above $100 creates winners and losers even before price moves again. Because the physical market is splitting into two different worlds, liquid silver and trapped silver. Refiners have effectively stopped buying alloy product like 90% constitutional coins and sterling, or they're pushing payouts out from 10 days to 3 months. That sounds like a back office detail until you realize what it does to real exits. Dealers survive on speed. They need to buy, flip, and recycle cash. If refiners won't take your products quickly, dealers either widen spreads or stop bidding. This is where the story flips. Melt value can rise while real liquidity collapses. Notice what's missing in the excitement. Nobody talks about the moment you try to sell. And in the next phase, the wrong kind of silver can make you rich on paper and stuck in reality. And while retail is celebrating the breakout, sovereign pricing is quietly setting the new floor. The U.S. Mint repriced proof silver eagles to over $170 per ounce, roughly double spot at the time. That's not just production cost. That's an institutional signal that the current range is not viewed as a peak. It's viewed as a baseline. And once an official issuer posts triple-digit premiums, it rewires the public's anchor. Suddenly, paying $110 or $115 at a local shop feels cheap compared to $170. This is how a bull market becomes durable, not by convincing everyone it's fair, but by shifting what everyone accepts as normal. Here's why that detail changes everything. When official pricing runs ahead of the market, it creates demand pressure everywhere else. And the scramble that follows is where premiums explode. That scramble is already here. A whole new universe of buyers has entered. People who aren't buying because they understand silver, but because they understand the dollar, buying less every month. This is the Veblen effect in real time. Demand rises as the price rises. Dealers can buy 6 figures of inventory daily and still have empty showcases because retail offtake is immediate. That's not healthy behavior. That's frenzy behavior. But here's the part you need to see clearly. Mania doesn't just lift price, it destroys access. It makes physical harder to find and more expensive to secure. So the danger isn't just chasing. The danger is buying whatever is left on the shelf. In a rush, people stop choosing the right form of metal and start choosing whatever they can grab. And that's exactly how liquidity problems spread, even while the charts look perfect. Now look at the institutional side, because this is where old assumptions die. The short trade has effectively capitulated. There may be millions of shares available to borrow for shorting silver, but there are virtually no takers, because trying to short this move is being treated as pure insanity. That's not a normal market signal. That's fear inside the professional class. And it suggests the violent downside smashes people waited for, those sudden $5 drops in minutes, are less likely to be the main feature of this cycle. Or they'll be shorter, sharper, and bought instantly. Stop waiting for the manipulation crash to give you your perfect entry. The market structure has shifted, and the forces that used to lean on price are now positioned to ride it. What happens if this continues? Because if this continues, it doesn't stay inside finance. It moves into daily life. When silver runs like this, you don't just see higher numbers. You see shortages, delays, and rising premiums that feel like a tax on being late. You see people lining up, calling every shop, trying to grab anything before it's gone. And even if you're not a trader, you feel it as a signal. Something about trust is breaking. This affects ordinary people through higher costs, tighter budgets, and a growing sense that the system can reprice your world overnight. If you've ever watched prices jump and wondered how anyone is supposed to keep up, you already understand the psychology. If this feels familiar, say so in the comments. Because the metal isn't just moving. The behavior around it is changing. And that change is what decides who survives the next stage. This is where the story becomes smarter than the headlines. Silver isn't moving because of one reason. It's moving because multiple systems are aligning at once. Momentum, fear, scarcity, and global flow. And the mechanism is simple but brutal. Once triple digits print, every delay becomes expensive. Buyers don't need a thesis. They need a reason to act. Dealers don't need an opinion. They need inventory. And institutions don't need permission. They need protection against being wrong. That's how melt-ups form. Not from hype, but from incentives that all point in the same direction. Here's the unsettling insight. The market isn't asking whether silver should be here. It's asking how long the supply chain can keep up. And when the pipeline breaks, price doesn't fall. It gaps. And now the center of gravity is shifting east. China is trading silver at roughly a $10 premium over Western spot. And that spread acts like a vacuum, pulling physical metal out of Western vaults. The screen price you see in the West starts lagging behind the price that actually moves inventory. This is why dips become dangerous to bet against. Any weakness gets bought not just by speculators, but by arbitrage flows shipping metal toward the higher-paying market. Two paths form from here. In one, the spread holds, and the West reprices upward to match it, accelerating the move toward 150 and beyond. In the other, volatility surges as supply strains trigger sudden pauses and sharp squeezes. Either way, the next move isn't random. It's already forming in the gap between paper pricing and real-world demand. So what do you do when silver is winning the race? You start thinking like someone who wants to keep the win. The gold-silver ratio has already compressed below 50-1, with gold near $5,000 and silver over $100. That means silver is outperforming, and history suggests the ratio could fall further, toward 30-1 or even 15-1. But this is where disciplined investors stop being entertained and start being strategic. The smartest move isn't even all in forever. It's staggered rotation. As the ratio drops, you trade some high-volatility silver gains into more stable gold, locking in the rally without betting your entire future on the next swing. The deeper insight is simple. Silver can make you rich fast. Gold helps you stay rich. And finally, understand the endgame risk most people ignore. The price can be high while the system becomes hard to use. Taxes and jurisdictional friction can widen spreads and destroy local liquidity. A 10% bullion tax can push buyers across state lines, hollow out local shops, and force people into longer drives and tighter transaction behavior. Layer that on to refiner refusals and delayed payouts, and you get the worst-case structure. You're rich on paper, but selling quickly becomes a problem. The future splits into three outcomes: a melt-up where momentum goes parabolic and $200 becomes realistic fast; a structural grind where silver holds above $100 and climbs through volatility; or a liquidity trap where the scream stays high, but the real exit gets harder. The only way to win all three is simple: hold the right form, plan your exits, and stay ahead of the system before it tightens.